Dear investor, in this month, let us look at the following. The state of our external debt and with some extra focus on short period debt. Reduction in commodity prices and with it improved inflation outlook. Economic slowdown and bond yields. Now, these are things which go into framing our thoughts on valuation and ultimately the market direction. And yes, continuing on last period's discussion on flows, FPI outflows have slowed down, and we will speak on that. And ultimately, yes, valuations for our country. So the first subject, state of external debt and Forex. This is important because this is a period of great turmoil globally. Geopolitics is one thing, but with energy prices shooting up and with traditional Forex earning industries like international tourism, having not normalized, this is causing a lot of stress on the finances of several countries. In our neighborhood, we have Sri Lanka and Pakistan who are facing issues. When in this context, we examine the state of Indian Forex reserves, we see us as a country with one of the highest reserves globally. Forex reserves tends to provide us with a lot of stability. While reserves have dropped from the peak levels, as yet they are at comfortable levels. We note the change in RBI's stance towards allowing of INR depreciation. Hopefully that will reduce the pace of depletion of Forex going forward, though one should continue to expect some depletion given that the trade deficit should be expected to continue to be high given higher Indian growth rates versus global growth rates, and of course high crude. Also, in this context, if we examine the external liabilities of the government, particularly for the short term, we find that India's external debt to GDP, something that causes instability, is one of the lowest in the world, with and amongst EMs, as is short-term debt to GDP. And our Forex reserves cover for imports in terms of number of months is one of the highest. Hence, in the short-term, stress on this count is not expected. The uncertainty, the stress has to last for a very long time for it to wash on our shores. And many other countries would have got sinked over the period before, let's say, the fires reach our shores. Lower external stress should allow the market to function more normally with focus on earnings and valuations rather than if we had stress. Secondly, to note, commodity prices have reduced. They had started to fall last month. Many commodities have continued to fall. Supply chains have gotten smoothened. Export restrictions in countries like Indonesia on palm oil have been reversed. All of that has helped. Export tax that India has levied on some commodities has increased the availability in the domestic market and reduced domestic prices. The trend of down move in commodity prices continues, and some of the government actions to cool off prices may get reversed over time if the lower prices stick. While oil prices have reduced from their highs, the crude prices, they continue to be elevated. We were following the visit of US President to the Middle East, to Saudi, but it has not delivered much in terms of production increases. We believe that reduction in oil prices are the solution to several of the stresses that Indian economy faces. Our equity market bottoms have coincided with high oil prices, and markets have bounced back when oil has receded. To have some sense, a $30 reduction in oil prices would shave off over 40 billion in our import bill. and go a long way in neutralizing USD demand from other avenues in the economy. So oil is something that we are watching on that count as well. A few comments on inflation, economic slowdown, and bond yields. What is happening is that after rising sharply in response to increase in regulated rates, the bond yields have softened across the world and sharply in the US. Yields are experiencing two conflicting forces. One, there is this upward push on account of increase in regulated rates. Here, we continue to expect next rate increase to be large one of the order of 75 bips in response to high inflation, even though commodity prices have fallen because policymakers have said that they would be looking at data. Overall outlook on targeted Fed rate is now more open to debate, though, and over time we could see some more. We could see some downward revision, or at least mix in thoughts that are shared if inflation trajectory reduces, if commodity prices continue on their downtake. The other contrary force that is there is the force on bond yield, the downward force push on the bond yields on account of economic slowdown. The prospects of a US economy undergoing at least a shallow recession is high. In a scenario where availability of job far exceeds the labor supply, this is something which is not exactly negative. Already, we do believe some bit is beginning to bite. Surging inflation and interest rates, for example, are weighing down on US housing market, for example, while prices there are high. The transactions have reduced. Weekly mortgage demand that gets reported have fallen to a lowest point since 2000, as buyers have lost considerable purchasing power as interest rates have almost doubled since earlier this year. Overall, we do expect further rate increases to have lesser impact on moving the yield curve up, both in India and the US, because like we said, prospects of economic slowdown would provide a counterforce. In the event of regulated rates not moving up much, when we see the next rate increase, I think we could then say that rate increases, the what is there in the public domain, what is there in the expectations domain of 3.75 to 4 kind of region for the Fed rate, I think would then be deemed to be discounted by the market. And in turn, equity markets could also see reduced volatility and sustain its bounds. However, if there is a surprise element on either side, lower rate increase or higher rate increase versus expectation, markets would have to digest that. FPI outflows have reduced. We had covered this section in detail in last month and concluded that FPI outflows were mostly on account of relative valuations, rebalancing and favoring of, let's say, commodity exporting countries. And this coincided with the value style coming into focus versus the growth style. Now, with commodity prices declining sharply in many cases, we believe we had thought that over 4% rebalancing that the market had seen on account of outflows was already large, and we should be seeing smaller outflows. This seems to be bearing out. Reduction in bond yields. Over time, we have seen 3.4% bond yield getting reduced to just about 3 in the US. This is again helping bring some focus back on growth assets. FPI selling pressure is reduced in the month of July. We have had several days of good positive flows. If bond yields do not move up much after the next rate increase expected towards the end of July, the focus towards growth investing should return. Domestic interest in equities is proving to be more structural, and flows into MFs have continued to be positive. While yes, there is an indication that retail activity is reducing. The third bit in the flows is IPOs. They were sterilizing a lot of liquidity. However, with the volatility in the market after the LIC IPO, the IPO activity has reduced. Uh, this has allowed much better support to the secondary market in terms of flows, and markets have delivered an anticipated bounce. IPO activity is expected to remain subdued in the near future, and that should allow for some more breathing space for the secondary market. Change in direction of flows is also coinciding with re-emergence of growth style of investing. FPIs were major investors into this space, and during the period of strong FPI selling, we did see this style of investing lose flavor, which now seems to be returning. In India, we believe, one of the best exponents of this style. And in the month of July, our portfolios have seen a bounce better than that of the market after, yes, 2 months of weak results before that. Domestic investors should be sensing the change in selling momentum of FPIs. And we do hence expect secondary market retail activity to pick up, which had shown some amount of sluggishness in the recent past. We do overall expect domestic flows to prove more structural given the improving per capita incomes in the country and financialization of savings. A few comments on the valuations and quarterly numbers. Quarterly result season has started. This quarter is expected to provide the largest YOY jump in profits in this fiscal. This is going to be the largest growth quarter. After this quarter, the base effect would be less favorable. Second quarter is expected to be lower growth quarters. But yes, the festive season could see some support of lower base that got impacted a bit by resurgence of COVID in the last period. We in this quarter expect to see a 30% increase in profits for Nifty, while the broader universe should deliver close to a 20% YOY increase. Favorable base should benefit autos and financials. Private sector banks should see lower treasury losses and hence deliver better profits. While PSU banks, because of a longer duration bond book, could see higher mark-to-market losses. This is to be seen more as a one-time thing. Going forward, financials should continue to do well. Select companies in the upstream oil space, large companies like Reliance, Coal India, ONGC should do well. These companies are actually accounting for a large part of the profit increase that Nifty is expected to deliver in this quarter. On the not so positive side, steel and cement companies should deliver a degrowth in earnings. IT companies, the other large space, would experience some margin squeeze and should deliver muted growth. Overall, as yet, earnings outlook for financial 23 and 24 is sustaining. After ending financial 22 at 729 kind of EPS, in financial 23, we expect this to move up to over 860, and financial 24 hit that 1000 mark on index earnings. Now, while markets have bounced back, the valuations are still on the cheaper side when seen in the historical context, particularly adjusting for the changes in the index over a period of time. If one notes how the cheap part of the index, which was a large component of the index over time, has seen its constituents go out, and in the higher P part has seen more inclusions. So weightage of, for example, NBFCs, private sector banks, consumers have gone up over time. Life insurance and retail has also seen an increase in the index. The changed composition of the index implies that valuations can sustain at a higher level. However, yield gap analysis shows that unless yields are expected to reduce, markets could move in a range, and this is something we should be aware of. However, markets are forward-looking. If inflation expectations fall and bond yields show some degree of softness, I think markets could continue to be stable to buoyant given the valuations where they are. Movement of oil prices would hence be tracked closely. Overall, to sum up, I think there are good chances of current bounce seen in the markets continuing on cheap valuations. The growth style of investing should again find traction on reduced FPI selling. And yes, helped by continued buoyancy in economic growth, led by yes, consumption in the short term and capex over the medium to long term. Thank you and happy investing.